Hello, everyone, and welcome to today's FX Monthly webinar. I'm Brian Dangerfield. I co-head G10 FX Strategy here at NatWest, sitting in the US. And today we're going to talk about the outlook for foreign exchange markets in light of the US and Israel joint attacks on Iran at the beginning of March. So clearly, a lot has changed in the last couple of weeks here. Things are still very much in flux. We are recording today's webinar on March 11th in the UK afternoon. So some of the details here might have changed. The situation is certainly very fluid by the time you listen to this. But if we can go to the first slide, please. Just want to make a quick comment on how recent developments have really upended markets. And the first one is certainly the high profile increase in energy prices. So we show that on the left. 50% year to date is roughly how much oil prices have increased since the turn of the year. Now, not all of that occurred in the aftermath of the US-Israel joint strikes in Iran, but of course, a good chunk of that increase is specifically linked to this escalation in geopolitics. And now I think the big focus here has been on oil and energy coming through the Strait of Hormuz. So not specifically around lost barrels from Iran specifically. Now, Iran is an oil producer. Most of its oil does not go into the open market. It's widely believed that China is the primary purchaser, or maybe only major purchaser of Iranian oil because of the U.S. sanctions and secondary sanctions regime. But a significant amount of seaborne oil and energy flow transits through the Strait of Hormuz, which crosses Iranian territory. And that accounts for almost 20% of global oil supplies that move, that move through this critical strait. Now, there are some alternatives for Gulf states. Saudi Arabia, for example, has other alternatives to avoid the Strait of Hormuz. But the broader point is that the ongoing conflict has really dramatically slowed oil exports through this critical transport hub to the extent that we are now facing the possible risk of acute supply shortages. This is most severe, at least looking at oil, for Asian economies, and that's what we look at on the right. This is from the US EIA, estimating the destination of oil that transits through the Strait of Hormuz. Now, you can see that Asian economies primarily make up the bulk of this demand, specifically China, but also India, South Korea, Japan, and other Asian economies, primarily the source of demand for oil moving through this channel. The United States significantly less so. While Europe is relatively low in terms of oil demand, it's still an important for natural gas because we've also seen disruption in other energy products such as natural gas moving through this channel. Qatar Energy, for example, has significantly pared back production of LNG, liquefied natural gas. And what we've seen in Europe is that natural gas prices have also increased substantially as a result of the conflict. And so markets, I think, are trying to balance two different but related drivers, which is number one, that oil prices have gone up substantially. And number two, that there is the prospect over time that the longer the conflict goes on, the longer oil transit through the Strait of Hormuz is blocked, the greater the risk of acute supply shortages in oil. If you can move to the next slide, please. Now, let's talk about the foreign exchange market reaction and why we saw the reaction we did. And the first order impact was a broadly stronger dollar. And I think that reflects two major drivers. The first is positioning, and the second is expectations around shifting growth. So, in the first order, our assessment is that we think the market was leaning short of US dollars heading into the last weekend of February when the attack began. And we can see this with CFTC positioning data. This shows speculators on the left-hand side, that dark purple line, with speculative net shorts actually heading into that weekend, heading into the start of the conflict, by our estimate at local extremes, among the more extreme dollar short positions we had over the last couple of years. Now, I think this reflects a number of potential drivers, some of which we still subscribe to, such as the risk of potential de-dollarization and asset rotation. U.S. equities had started the year relative underperformers to many of their non-U.S. peers, and particularly in some emerging markets. Additionally, the U.S. economy, I think, while more resilient than I think most expected, is just in a different fundamental position than it was just a few years ago in terms of a weaker labor market. And we'll touch on those drivers as we go through the presentation. But Part of this move stronger in the dollar, we think, is positioning. That risks to the dollar. The market was positioned expecting a weaker dollar. This geopolitical change happened, and we've seen what I assume or believe is a significant correction stronger in the dollar. So my assessment of positioning is that positioning went from modestly to, in some cases, significantly short dollars to a much more neutral position here. And that positioning squaring is one big piece of this dollar move. And the positioning piece, now that positioning, I think, has more normalized, maybe the risks to the dollar around positioning are less extreme than they were in the initial sessions after this move. The second is from relative growth and the market's assessment of where the growth risks are most severe from lost oils and higher energy prices. And here is where the US has an embedded advantage from two factors. Number one, it is a net energy exporter and significant production of oil here in the United States. Additionally, most of the oil that we do import does not come from the Persian Gulf. Almost the lion's share of U.S. oil imports comes from Canada. But more broadly, the Western Hemisphere accounts for most U.S. oil imports. So Canada, Mexico, Guyana, others, including Brazil. These make up the lion's share of U.S. exposure to foreign oil. And a good chunk of that oil, especially in the Canada-Mexico case, comes via pipeline. And so it's not seaborne oil as well. And so our exposure here in the US to acute supply shortages because of blockages of the Strait of Hormuz is less severe. Additionally, I would add that because global energy prices are denominated in US dollars, then there is a bit of a double whammy style effect when oil prices go up in dollar terms and your currency goes down against the dollar. So let's take euro as an example, that if dollar denominated oil prices are going up and euro dollar is moving down, then the cost of oil in euros is actually accentuated. The move higher in oil prices is accentuated by the weaker currency. And so I think these are two important metrics to think about the dollar from here, which is the positioning side, which may be closer to the end of that story, and then the relative growth side, where the US is relatively less exposed to potential growth weakness that comes from specifically supply blockages in the Strait of Hormuz. And so I think the market has in part adjusted to this new landscape. Can you move to the next slide, please? But one thing that I think is important to flag as we think about this relative growth picture and how the US, how the dollar has reacted, is that I think this is a very fundamentally different posture for the US economy than it was in 2022 when we were considering these same questions as the result of Russia's invasion of Ukraine and lost energy supplies. There are a myriad of differences between this situation and that situation from 2022, but an important one to highlight is that the US economy is structurally in a very different place than it was at that time when that move was associated with significant strength in the dollar. And where you can really see that is in the employment picture, which is in 2022, we were coming out of the pandemic, still coming out of pandemic related shutdowns, and the US economy was really firing on all cylinders. We're simply not in that same position now. If anything, private sector job growth is effectively running at zero. The US economy, I think, by a lot of metrics, has been resilient. But by that same token, the labor market has clearly slowed. And I think the US is not in the same exceptional position that it was during the Russia-Ukraine escalation and significant rise in oil prices in 2022. And so this is something that I think maybe blunts the impact in terms of the market flooding back into this idea of US exceptionalism, dollar exceptionalism, is that we're facing down these global growth risks from Iran at a point in the cycle when the US is just not accelerating, growth is not accelerating to the extent that it was in 2022. A secondary question would be that while the US is relatively less exposed from lost energy product, prices still matter, and retail gasoline prices in the US have actually risen pretty substantially. So for the average AAA at the price at the pump has gone up about 50 cents a gallon here. And for a driving centric consumer based economy, this is a potential hit to discretionary spending because the more individuals have to spend on fuel, this is true everywhere, but in the US is no different. The more individuals have to spend on fuel, the less discretionary spending they have to spend on other things. And so this is a potential risk to consumption that I don't think should be discounted, even though the impact on from higher oil prices on global economy certainly feels like the risks are more severe in non-dollar economies because of some of the factors we discussed earlier, that I don't think the US economy is in as exceptional a position to force a return to the sort of dollar exceptionalism type environment that dominated in sort of the post-pandemic era. Can you move to the next slide, please? The other factor to consider is front-end rate repricing and how it's not all been one way. And what I mean by one way is that it hasn't just been that the market is repricing expectations for the US and not anywhere else. Front-end interest rate differentials are a really important driver of foreign exchange markets. And if you're a regular in this webinar series, you'll have certainly seen me discuss this topic before, which is how the US dollar has traded very, very closely in line over time with the evolution of front-end interest rate differential. So specifically on the left, the difference between two-year yields in the US and its other partners. In this case, we've weighted it for the dollar index, the DXY, to reflect the differences, to compare it to the dollar index, the trade weighted dollar. And what you tend to see is really until Liberation Day tariff announcements in April 2025, this relationship was about as firm as they get. That when US interest rates were rising relative to its peers in the front end, the dollar was rallying and vice versa. Now, this relationship has weakened, but what I'll call your attention to is on the far right of the left-hand chart, where uh, moves in relative rates have not gone straight up in favor of the US. If anything, they've actually gone down a little bit. And the reason they've gone down is because the markets have repriced central banks in the hawkish direction across jurisdictions. So I'll give you one example, which is on the right-hand side. This is interest rate expectations for the European Central Bank. View September 2026 here as just a proxy, but really across the interest rate curve compared to a policy rate of 2%, which is where we are comfortably at the moment. And the market was pricing some modest risk of easing over this next, call it 6-month period. Since the turn of the month, this has changed dramatically, with the market now seeing some risk that the ECB is actually forced to tighten policy over this time frame because of higher energy prices. Now, again, this move higher in repricing, this hawkish move in repricing, has also happened in the US. But I think the important thing is that relative rates during the 2022 period of higher oil prices, higher energy prices, really exploded to the top side, reflecting this market idea that the Fed would respond more aggressively because growth was stronger. It's simply not the case this time. And if anything, relative rates aren't telling us that the dollar should be materially stronger from here, although it's important to note that this correlation has certainly weakened in sort of the post-Liberation Day period throughout parts of 2025. Can you go to the next slide, please? So now we talk about, I do want to flag the war itself and the ongoing conflict. And one of the big questions in the market that as we sit here today on Wednesday, oil markets had a very significant round trip on Monday, with oil benchmarks rising well above 100 barrels per day on Monday. Since then, pressure has come down significantly. One factor has been the market's assessment that that major economies will soon release oil from strategic petroleum reserves to try and counteract some of the potential shortfalls from lack of oil from the Strait of Hormuz. But another factor has been the market's assessment that President Trump may be trying to signal to the market that the war may be over soon. You've had a couple of comments in that direction. And now I think it's fair to say that the president has shown some mixed signals here in terms of ultimate goals of these operations. In some senses, there's been this sort of expectation that anything short of surrender and regime change would not be an acceptable outcome for the United States. In that case, it feels like the conflict could be prolonged for a potentially significant amount of time. But in other instances, there's been reference to eliminating or reducing Iran's ability to use small arms ballistics, for example. And on that front, the U.S. sort of has been posturing and signaling that a significant amount of that effort to reduce that capacity to cripple Iran's military is already complete. And so I think the market's assessment of when the active combat will actually end, which is, I think, an important moment in terms of resumption of oil supplies, still feels like it's very much in flux at the moment. But one thing I think the market will be watching closely is not just retail gasoline prices, but how they link into the market's assessment of whether the president is feeling any domestic pressure from voters to pare back the fighting. Now, certainly, this move higher in energy prices, gasoline prices, we're very early into this move, and so we don't have a ton of polling. But what we continue to see as we head into midterm elections is that Democrats are outperforming in what we call the generic ballot, which is when you ask voters whether they prefer Republicans or Democrats. That tends to have a really good bearing on the outcome of that year's midterms. And so Democrats holding a modest lead here is probably a good sign for them to take back the House in November, although this hasn't really moved materially. On the President Trump approval rating, his approval rating's actually gone up a touch by the average metric that we trace. You could look at every poll is going to be a little bit different. Some tell you a different story. Some tell you that Trump's approval rating might be firming slightly. Others tell you that it might be easing back slightly. But again, these are the metrics that if we believe that the president is feeling the pinch from local voters, from the populace, to try and scale back the conflict for the sake of lower energy prices, then these are the kind of metrics that we should be tracking. But I think we should be humble here and say just bluntly that it's very difficult to have a firm expectation around when the war will be over, when the active combat will be over, and as a result, what is the prospect for oil and energy product to swiftly resume through the effectively closed Strait of Hormuz. So I think we need to be humble about that. That there is an outlook where the conflict ends a lot sooner. Oil supplies normalize more quickly, and the dollar comes under pressure as a result of that as the market prices those risks away. And there's an alternative scenario where the fighting drags on, oil prices remain elevated, and blockages continue to put downward pressure on global growth to potentially the benefit of the dollar because of the potential higher downside risks to non-dollar economies that become from their more direct exposure. Can you go to the next slide, please? Now, I do want to make a quick mention of sterling and its sort of position in all of this. And, we showed this chart on the left for the European Central Bank, very similar in the United Kingdom, where the markets have priced back expectations of easing. Certainly a very different posture in the way the market was assessing the outlook for the Bank of England to ease policy. Certainly before this escalation in Iran, the market was pretty bulled up on the prospect of the Bank of England cutting the policy rate in March. Those expectations have moved back pretty severely. And this is something that I think, let's call it a mixed bag for the UK, right? Because expectations for Bank of England easing are moving back for what you would certainly call the wrong reasons, because higher energy prices are certainly not a good thing for your economy or currency. But higher interest rates do matter because higher interest rates are, an important input into carry decisions. And the Bank of England currently enjoys front-end interest rates that are quite a bit higher than most of its major peers. And that's probably something that we think will, only get that differential might only get wider as we go through the year if the Federal Reserve resumes easing in the back half of 2026, which we still expect. And so this is something that I think is potentially a positive for sterling here, which is this market pulling back of expectations for Bank of England easing. But as I mentioned, of course, it's a bit of a double-edged sword. But as always in the United Kingdom, we're balancing short-term and long-term drivers from the interest rate side, because while we've priced out Bank of England easing, which I think can read positive for sterling, at the same time, you've seen interest rate differentials in the United Kingdom, maybe showing some signs of weakening here in the longer end of the curve. And I think this reflects a couple of different factors, including concerns around fiscal policy. Certainly, as you increase oil prices, This is something that potentially leads markets to wonder if there's a fiscal response. Does the UK have the room fiscally to deliver a response to maybe try and shield the impacts from growth? I think that headroom maybe is limited here. And so the sterling has shown sensitivity to long-term interest rates, higher long-term interest rates relative to its peers as a negative driver because the market, has seen these fiscal concerns as filtering into negative sterling sentiment. And so I think this is something very important to track here. Is this short-term versus long-term interest rate differential picture for the United Kingdom I think it has been one of the big themes in sterling for a long time and continues to be a theme. So with that concludes my portion of today's webinar, and I'm very happy to pass it over to Piers Leslie to talk technicals. Piers, go ahead.
Thanks very much, Brian. I hope I'm not on mute. Thanks very much. Very interesting stuff there. So we're going to look at it from the price action now, just on some charts. So we can go to the charts, please. So the first chart we have here is the dollar index chart. So this is the monthly chart that I've highlighted a few times. We've had pressure on that line. So the pressure is still potentially there, and price still is bouncing along that line. It did try breaking through. We had one clear month close below it, but it rallied back up and closed above it. To get a true break of a trend line, you need to see 2 consecutive clear monthly closes below the trend line. And that's what we'll need to see if we're going to go for a weaker dollar. Initial resistance on the upside is going to be around the 101, 102 area. And you need to see price back above there to start to think, actually, this is a proper reversal and a good bounce off the trend line. Until then, that pressure stays on the trend line, and we just have to wait and see how that goes. But as I said, above 101, above and 102, you need to get above there to get more positive longer term on the dollar. So that's the dollar index. And that's just a good bellwether for all FX markets to know what the dollar index is doing. So we go to the next slide, please. This is sterling dollar. So I've decided to start, even though it's the monthly call, because we've had this one on quite a bit. This is the yearly chart. I've shown it many times on these webinars, and it explains why sterling dollar stalled where it stalled. So last year we saw it stall at the 137, 138 area. And again, this year it stalled when it got up into that area. We didn't get a weekly close above that area. And why is it? It's simply the 23.6% retracement of the collapse since 1980. So for 30 years, you saw that act as support. Then Brexit took it through that 23.6. And the simple rule of polarity says old support switches to resistance. So every rally since Brexit, every year sterling dollar's rallied, it's been capped by that area. So to get more confident on sterling dollar, you need to see it up through that 138 area, 139, just to give it a bit of breathing space. So while you're below that, that's going to act as resistance. But that's a long time to wait because it's a yearly chart and we have to sort of see. But I'm just trying to explain to people why did sterling dollar stop where it stopped? It wasn't a surprise. It was just a sort of another continuation of that line. So if we go to the next slide, please. This is bringing it down to right now, the monthly action on sterling dollar. So what can we see on this chart? This is showing a monthly chart since 2023. We've been in an uptrend on sterling dollar. So an uptrend is where you have higher highs and higher lows. And that shows that the buyers continue to buy the dips and they push price off those higher lows and print higher highs. So that's the standard definition of an uptrend. So what's happened? That uptrend has now hit the 137 area. And that's what stalled it last year and this year. And that is why I showed you the slide before to explain why it's stopping there. So now it's just a battle. And I call it the battle map because to get a sterling dollar continuing higher and this uptrend to continue, the two top levels there, the 137.70 and the 139.35, you need to see sterling dollar push above there on a monthly close, hold clearly above sort of maybe say the 139.50, get above there. that would be a very good signal if you want sterling dollar higher. But the risk is, at the moment, there's short-term resistance at 135. 135.00 is the exact sort of level. And I think there's some resistance there. And to get an attack on that area, the 137 area, you need to see price holding above 135. Then we might get an attack at that stronger resistance, which remains the key resistance to remember. Support, where's support? So we know where the resistance is. The support is going to be, for myself, the key one, I think, is this 38.2% at 131.30. So 131.30 to 130.180, I think that's your key support. You don't want to see sterling dollar get a monthly close below that. That would be the first sign of potentially weakness coming here, and that top being more important. So where does it start to get very serious for sterling dollar? I think if you saw a move back below 129.50, 130.10, that would suddenly start to be a concern that maybe a long-term topping formation is coming off that 137, 138 resistance area. So to summarize that, keep watching the uptrend, but be careful in case price starts to break back below 129.50 on a monthly close, because that would suggest the uptrend is starting to fail. So we go to the next slide, please. This is sterling euro. This is a lovely chart. It's worked very well for sterling euro for a couple of years. I used it last year, use it again this year. What it shows many times is that when sterling euro falls down, what's supporting at the moment? It's the Ichimoku cloud. Now, in 24 and 25, to start with, it bounced off the top of the cloud. But slowly, as the year went by, it went into the cloud and is now using the base of the cloud as support. So we've got that bounce off it. There's an impulsive bounce off the bottom of the cloud. But the levels I highlighted last month still remain the key levels. It's 116 to 116.5, basically. That is the resistance. And if sterling euro is going to go higher and you want sterling euro higher, you need to see it take out that resistance area of sort of 50 pips, and then you could see further gains higher. But at the moment, I think that will cap sterling euro for the moment. The base of the cloud is support. So I'd watch 113, 114 as a support area for sterling euro. And where would it start to get negative? Where would it start to suggest sterling euro is about to collapse again? That would be if it got down below 112.50. You're below 112.50, you're back below the cloud, things won't be good. But just for the moment, I just watch a 113, 114 to potentially 116, 117 range on sterling euro, with any move outside those starting to show a change of feeling. You know, someone's starting to take control, because it has been, as you can see on that chart, for about 6-7 months, just sideways price action. And the final slide, on the next slide, please, is euro dollar. Euro dollar, we had a nice move here. We went to the 100% extension. So we look at those Fibonacci extensions. Where did price stall? It stalled round the 119.18, 120 area. So what stalled it? If you look there, 3 times it tested the 100% extension. And that's just what's capping euro dollar. So if you want euro dollar higher, you need to see a monthly close above 119.18. But at the moment, there's a couple of things against euro dollar. 6 weeks ago, so way before all this conflict started in the Middle East, you had something on my weekly charts, if you get them, called a gravestone doji, which is a strong reversal candle, Japanese candlestick reversal. And since those 6 weeks, euro dollar's just come off. So what it's doing now, it's coming down to find, right, we hit the 100% extension. You fell off the 100% extension with a weekly reversal candle, very strong weekly reversal. They call it the death of a trend, the gravestone doji. And that's coming down. So now we have to see how the support holds up. So the buyers have to arrive either at the 115 area, 115.07. So any weekly close below that would be a bit of concern, and a monthly close below that would be a concern. It would probably open up then the 113.5 area. Now that's the 38.2. So that's the real key area. You don't want to see price really here getting down below 112.50, 113.50, because there should be a lot of buying interest there. It's also the previous highs from 2023. So there's a lot of stuff there in that 112.50, 113.50 area. If the buyers aren't there, then it signals the end of the impulsive uptrend that we saw into 2025. But for the moment, I'd look for support initially at 115.07, see how far that rally can get. It really needs to take out 117.25.30 as its first area. But to get back positive, you need to see price back above 118.35, 119.25, I'd say. A weekly close above that, that would start to open the upside again. So to summarize that, it's pressure on the downside if you break below 115 down to sort of the 113.5 area, and it needs to get above 117.25.30 to take the downside pressure we're seeing off at the moment. And the next slide is just the disclaimer, and that disclaims me for everything I've said, and that is my part done. Thank you very much. Hope you enjoyed it.
Great. Thank you very much, Piers. And to everyone, thank you so much for listening to this month's webinar. If you enjoyed it, please, reach out to your NatWest sales contact to give any feedback or any additional questions. And we look forward to next month's edition. Thank you so much.